the other components that we haven't really mentioned here yet, but it's crucial whether you're talking about bad beta or sort of less optimal beta and moving towards more diversified, better beta, let's call it, is the frequency of rebalancing, right? I mean, we were talking about this offline and how the S&P is an active strategy once you drill down to its constituents and how it gets rebalanced, and it's got a growth momentum tilt towards it. And the way that you implement risk parity can also vary quite a bit, whether you're running it countercyclically or pro-cyclically, and how often you rebalance. We wrote the Rebalancing Premium white paper that talks specifically about how you can earn an excess return just on the basis of this rebalancing. But that's also, I think, a key component for us to talk about, and how, again, this type of beta is not a beta that everyone can do on their own, and it's somewhat more sophisticated and requires a little bit more implementation than what people might expect by just holding equity beta.
Yeah, I think
there's a lot there
emphasis
too, Rod.
Yeah, go ahead, Mike.
Richard. Well, I just think that brings into, what does and we talked about this previously, what does the structure allow? What is the ability to actually gain enough leverage to include all of the asset classes? Is there any limitations that you're facing on boots on the ground that feed back into the calculations that you're making that you have to adjust for? So I mean,
ability
there's a
or
lot
willingness.
There. Yeah. Well, there's a behavioral side of it too. Yeah, you're absolutely right. So there's a lot there. I'll let you guys decide which.
Yeah, there is, and I think I think in the interview that you did with Antti Ilmanen, one of the things that stood out for me, and we did the work on it in the Optimal Commodities paper that we wrote, was how people have a tough time agreeing or believing that there is a positive risk premium for commodities, right? We say, what are you talking about? There's no rational reason for as to why any single commodity is going to have a yield that's going to be expected to make any positive returns over time. But where this magic really comes from, where the yield that we achieve in commodities comes in the fact that there's significantly more diversification across the commodity spectrum than any other asset class. And when you apply a well-diversified portfolio of commodities and rebalance them at a certain frequency, you extract a rebalancing premium for free. It is entropy, being able to grab from the winners, give them to the losers before they mean revert, that provides that excess return over time. So you can't. Maybe you can make an argument for gold, although gold has its own characteristics that has no yield, but you really can't make it for a well-diversified commodity index, right? And there's new indices coming out for public consumption that are getting closer and doing better with the rebalancing premium, but the ones that are the most liquid out there, the ETFs that are available, tend to have the same issue that we've been talking about, which is an imbalance from an optimal commodities perspective, where we're overweighting based on liquidity of the energy markets and underweighting on other commodities that can offer significant rebalancing premium. So the rebalancing premium is a crucial discussion to have on the commodity sleeve. But then, of course, once you have that tight and you have that dialed in, that commodity bucket, the equity bucket, the fixed income bucket are also quite differentiated. And that entropy harvesting that you have will create an excess return, which is going to another objection that people have. Is like, why would I invest in bonds right now? They're yielding nothing. Or why would I invest in equities? They're so overvalued. Well, because in order for you to move away from an optimal weighting between those three buckets, remember, in our paper we showed how the rebalancing premium, assuming a zero return across all assets, is around 3%. The rebalancing premium is very high. It actually rivals the equity risk premium. So, but the moment you overweight one of those buckets or underweight one of those buckets, the optimal rebalancing premium goes down. So if you have a real view on, I want to go long this or I want to take out that, it's not just how much you'll make with that view. It's that there is a benchmark that you need to beat, which is how much above the rebalancing premium I'm giving up will I make to execute on that view. And that is absolutely crucial, right? The rebalancing premium is a large hurdle that every investor, passive investor, thoughtful, I have no view of the future, needs to make before they start having views on the future, if that makes sense.
Yeah. No, that's an important point, that just rebalancing alone in commodities is expected to produce a premium that rivals the historical equity risk premium at a similar level of risk, which is pretty remarkable.